Hello, and welcome to the Anti-Fraud Collaboration's webcast on building a fraud-resistant organization. The Anti-Fraud Collaboration represents the joint efforts of the Center for Audit Quality, Financial Executives International, the Institute of Internal Auditors, and the National Association of Corporate Directors. These organizations are actively engaged in efforts to mitigate the risks of financial reporting fraud and promoting the integrity of financial reporting. I'm Cindy Fernelli, Executive Director of the Center for Audit Quality, and I'm pleased to moderate our discussion today. Joining me is a panel of experts who will share their perspectives and actionable recommendations on how companies, from the smallest to the largest multinationals, can improve their efforts to fight fraud. The starting point in our discussion is a new anti-fraud collaboration report entitled The Fraud-Resistant Organization: Tools, Traits, and Techniques to Deter and Detect Financial Reporting Fraud. But before we get started, I do have a few housekeeping matters to address. Slide 2 provides troubleshooting tips you may find helpful if you experience technical difficulties. As noted on Slide 3, you may ask content-related questions at any time during the webcast by entering your question in the Q&A panel. You can also download today's slides by clicking the resource list icon. Slide 3 also provides instructions on how to obtain your CPE certificate after today's event. I'm also pleased to announce that this webcast qualifies for 2 NACD skill-specific credits, which can be applied to one of the 2 NACD fellow programs. For those of you who have registered for either CPE or NACD credit, you must confirm your attendance throughout this webcast by clicking the participation pop-up markers. So at this time, please take a moment to review the pop-up marker and simply click the green arrow. Also, please keep in mind that in order to obtain CPE or NACD credit for today's event, you must respond to at least 75% of the participation pop-up markers. If you did not register for CPE or NACD credit, simply ignore the pop-up markers, as they will disappear within 1 minute if they are not clicked. Slide 4 provides details on how you can learn more about NACD fellowship programs. So let's move on to today's program. Slide 5 lists our esteemed panelists, and I'm pleased to quickly introduce them to you now. Going alphabetically, we'll start with Ken Daly. Ken is the CEO of the National Association of Corporate Directors, which is the nation's largest member-based organization for board directors. Ken is a true expert on corporate governance and board transformation. Prior to joining the NACD, he was with KPMG, where he was audit partner and partner in charge of the firm's national risk management practice. Ken also served as executive director of KPMG's Audit Committee Institute and has chaired several audit committees. So thank you so much for joining us today, Ken.
Thank you, Cindy. I'm very happy to be here, and I'm very happy to be part of this panel today on an important subject.
Also joining us today is Carl Earhart. Carl is the Senior Vice President and General Auditor for MetLife. In this capacity, he has an independent relationship with the Audit Committee of MetLife's Board of Directors. He manages a team of audit professionals responsible for providing objective evaluations and advice on the system of internal controls and advocating for a global risk management framework. Carl joined MetLife in October 2002 and has more than 25 years of professional experience in accounting and operations for insurance, asset management, structured finance, capital markets, and derivatives. Carl, we're very glad to have you here today, too.
Thank you, Cindy. Excited about the conversation here today.
Great. Our third panelist is Tracy McBride, who is the Vice President of Research and Accounting Policy at Financial Executives International. In this role, she directs the activities of the association's accounting policy initiatives and oversees the works of its committees on corporate reporting, governance, information technology, and private company standards. Tracy has over 20 years of accounting, finance, and compliance experience across multiple industries. Tracy, our many thanks to you today to join us.
Thank you very much for having me, Cindy.
And last but by no means least is Rick Olche. Rick is the managing partner of U.S. Audit Services at Crowe Horwath LLP. In that role, he is responsible for all Crowe personnel performing audits, including audits of a substantial number of public companies. Crowe's U.S. Audit Services are delivered by nearly 1,000 professionals in more than 25 offices. Rick also serves as a member of Crowe's Management Committee and previously was managing partner of Crowe's Financial Services Audit Practice. We're very glad to have you on the panel, Rick.
Cindy, thank you very much. I'm looking forward to today's conversation.
Now, turning to slide 6, let's review what we're going to cover today. Our panel will dive into the 3 central themes of the fraud-resistant organization. Those themes are 1, strong tone at the top, 2, robust communications, and 3, skepticism. We'll give you a sense of how the financial reporting supply chain participants can incorporate important techniques in these areas into their respective roles. We'll address the challenges that multinational companies face in executing effective fraud deterrence and detection programs as well. And as discussed in the fraud-resistant organization, these challenges include language barriers, differing cultural norms, and conflicting regulatory requirements. Slide 7 shows our starting point, the fraud-resistant organization. In brief, the report drives home the point that organizations that encourage ethical behavior are more resistant to misconduct of all kinds, including financial reporting fraud. I should note that the focus of the anti-fraud collaboration is on financial reporting fraud in publicly traded companies, but the tools and techniques highlighted in the report are applicable to private companies, nonprofits, and government agencies as well. And they also are effective for frauds of all sizes, not just material frauds. While all participants in the financial reporting supply chain influence corporate culture, the anti-fraud collaboration's view is that culture begins with the tone at the top, with the company's most senior leaders. It then cascades through the entire organization to create the mood in the middle and the buzz at the bottom, reflecting and reinforcing that tone at the top. So turning to slide 8, Tracy, I'm going to start with you. Management has primary responsibility for setting the tone at the top and establishing the corporate culture. So why don't you share with our audience what some of the key elements of a good program are?
Sure, thank you, Cindy. Well, at first, it's very important that the top management establishes and communicates company values, and that could be in a variety of ways, including annual ethics training. And it's very important that not only your offices nationally but globally are considered during this process, and even more importantly, that on a daily basis, top management does focus on setting that tone and positive daily behavior. I think it's also important that there's an expectation that employees will do the right thing, and how that can be established is through the goal setting process and through performance evaluation, setting those expectations of what employees need to do and how they need to do the right thing. I think it's really important that top management not only talk the talk, but walk the talk. So most importantly, that was even mentioned in a recent SEC Enforcement Director's speech, and stating that internal controls or compliance processes, just having them in place isn't enough. It's about how you utilize that process. So it's very important that everyone's actions speak louder than words. Building an environment that employees feel comfortable about bringing forward bad news. Don't shoot the messenger. I think it's very important that top management has an open and honest communication and dialogue with employees so that they feel very comfortable in having those honest conversations to make sure we mitigate financial reporting fraud. And most importantly, when companies do value ethical performance, misconduct is substantially lower in organizations, less pressure and less retaliation.
So Ken, a lot of people might argue that the top of an organization is the board of directors or the audit committee. So explain to us what role you think that the board of directors, and particularly the audit committee, play in setting the tone at the top.
Sure. Well, clearly I think the audit committee, and frankly I think the entire board, should take the leadership in setting the tone at the top as part of the culture. But important part of that is what exactly are we looking for when we look at culture? And while collegiality, I think, is very, very important, I think one of the key issues beyond collegiality is there has to be a culture, a tone that manageable dissent, I'll call it manageable dissent, is okay. And I think an important aspect of the right culture is that, and actually Tracy hit on a couple of these things, is that you can say things which maybe are not groupthink and it's found to be acceptable. Now, tone at the top, to be blunt with you, I think it's fairly easy to set as far as telling people what it should be. Worst thing happen, you get the person in a headlock and you say, this is what I want you to do. They're probably not going to forget that. But tone at the middle, that is something that I think is extremely difficult to set. And one of the roles that I think the board and certainly the audit committee has is to understand how management evangelizes that tone and culture that they want throughout the organization. Because a lot of things that we're talking about, a lot of these frauds that we're talking about are actually, they start somewhere in the middle of the organization. And what my experience indicates is that evangelizing that can be extremely difficult. And we need to look at different ways to get that accomplished. Tracy hit on a couple of them, performance evaluations, which I think are absolutely critical, Tracy. I think you're right on the money there. Another opportunity might be exit interviews. Talk to some people who have left the organizations, hopefully you're doing exit interviews, to find out what they saw, what they actually believe. It's kind of like your last sentences as you walk out the door. There's probably a lot of honesty in there. So it's all about tone at the, first of all, defining what tone is that you want, what kind of culture you want. It's kind of like what you told your kids, don't listen to what I say, but watch what I do. And then try to find ways to make sure it's being evangelized and to make sure that the scent is okay.
That's great. And that actually answers one of the questions that we've already received from our viewing audience about what are some tangible examples of a valuable and valuing an ethical culture. And Ken, you mentioned that perhaps the middle is just as important, if not more important, than the tone at the top, what we call the mood in the middle. And the Ethics Resource Center recently issued a study on ethical leadership, and they asked employees how they evaluate their superiors. And so I'm just curious, Tracy, I'll start with you. Were there any surprises in that study that you found?
Not at all, and actually just to reiterate Ken's comments about that mood in the middle, it's important that, that middle management, along with top management, is viewed as treating each other with dignity and respect. So no matter at what level you are in the organization, there's a mutual respect and honesty, in interaction. Sharing credit and successes. It's important that the middle and top management does share in the success and not so quick to point the finger in a crisis, and that we all know we have something, we're all in it together, and that we really care about getting to the end game.
Great. So let's move on to slide 10. And Carl, I'm going to turn it over to you now and ask, what are some of the key ways that organizations can reinforce the importance of ethical behavior for their employees? And again, this goes to one of the questions that we got. Give us some real examples.
Well, certainly. I think bringing it down from the tone at the top, it's very important that we can have consistent behavior from all members of management that stress the critical thinking and analysis and challenging one another, asking questions. Now, there's things that we can do and we should have in place, like a code of ethics. A code of ethics basically lays out for us what we want to be as a company ethically. And we need to communicate that throughout the entire organization and do it on a regular basis. Have people read it, have people sign it, have people acknowledge it, at least annually. A hotline, which we'll talk further about today, a place where people can call, a place where people can feel comfortable sharing bad news.
Another one of the questions that we've gotten from our viewing audience. Yeah. So it's good that we'll talk about that.
With that, then, it's also the support network that's there for employees actually to be able to make those calls and feel comfortable communicating.
If I could add a comment, Carl, one of the things that I think becomes important is not just the existence of these activities, but the visibility of the activities in the codes. There are a lot of decisions that get made on a day-to-day basis that could be done against an ethical framework. And very often, teams within a company will have those conversations and maybe not explicitly draw on the ethical framework. They may speak to it or think about it and get to the right answer, but they don't necessarily talk with their team members about, okay, what is the how does this fit in with our company's ethics? And I really do believe that more frequent explicit discussion around how the pros and cons of decisions that are faced fit into those frameworks is helpful in raising elevating the consciousness around the ethical issues.
Well, you bring up a great point, because you need your team to do these things, right? Yep. Normally, I mean, there's obvious examples, but normally it's not black or white. You're going to rob that store, you're not going to rob that store. That's not really what the issues are generally. Usually what they are shades of gray. And unless you have your whole team around you to help you figure out what the right shade is and whether or not it's going in the right direction, it really, really becomes difficult. We probably, I don't think, want any Lone Rangers out there. We want people to feel as if they're part of a network, all that's supporting what it is that the organization wants.
So how does this apply to the board? Sometimes you hear about zero tolerance for violations
Right.
of the code of ethics or of the culture of the organization. But does that include the board as well?
Absolutely. I think absolutely it includes the board. There's a recent case, well, not so recent anymore, happened in Texas. We probably all remember it. Somebody came into the room and said, I've got a really great transaction here. It really doesn't fit into our code of ethics, so we'll have to suspend it for a brief period of time in order to do this, but it's best for everybody. That's probably not a good decision, right? I really think that the board has to constantly be sending and showing that it is a zero tolerance kind of thing. And a big part of that, I go back to my earlier comment, deals with the ability to be skeptical. I'm not talking about being skeptical to the point that nothing gets done, but we have to be able to recognize that dissent is okay, and that maybe it's not going to be 100% solution all the time, but if we show that dissent is okay, and we show that people are really serious about this, people will figure it out. I actually don't think people want to be part of an organization that struggles with culture and tone. I think people want to be part of some better thing. And I think it's up to the board, Cindy, to start that process by showing the way. That's why I say it's kind of the leader on this thing, in my view.
So let's move over to slide 11 and continue on with this theme, because we've gotten several questions about, again, give us specific examples of components of a strong ethical culture. And so we've got some of the thoughts up here. And as the audience is looking at slide 11 and thinking through some of these points, I want to open it both to Carl and Tracy, because you're inside the company. And talk about that, we all know that companies have to assess the risks within the company. And finding out, probing where the company might be vulnerable to fraud. And then also to set up a system of controls around those risks and then continue to monitor those. So discuss with us the importance and the components of a control environment within an organization for deterring and detecting financial reporting fraud. And also what the greatest challenges for monitoring and maintaining that effective control environment will be. So Carl, I'll start with you.
Well, certainly. I think even playing off the last slide and kind of coming in from a board perspective, something that we spend a lot of time talking about is transparency and sharing the right information with the board that they actually can make decisions, understand what is happening. So it's putting the right information about fraudulent activity in front of them. And as we bring that down into management, you think of the fraud triangle with pressure, opportunity, and rationalization. In this report that was put together, the Fraud Resistant Organization, which I enjoyed reading a lot, 2/3 of U.S. employees cited pressure to do whatever it takes. So when companies are so metric driven and so pressured to make the numbers, the gray area that you mentioned, becomes maybe a little more wiggly. So I think we have to understand the pressures that people are under in their everyday roles. And then the opportunity side is about really putting in place preventive and detective controls. Most fraud-related controls are detective in nature after the fact. But there are opportunities actually to build some preventive controls around analytical activity that actually can point us to where these things are occurring. So a little bit about reducing work pressures, a little bit about limiting the opportunity and knowing when there are patterns taking place that need to be looked at. Don't give them the opportunity to rationalize it's okay, and really be transparent about that communication, coming back up to management, senior management, and the board of directors.
And just to expand upon your comment about the level of information that gets to the board, and I think that's very important at every single level. So it's very important that every level employee feels that they are transparent in the level of data and financial information that they're providing, so it appropriately goes up to the chain and ultimately to the board of directors to make the best decision for the organization. It's interesting, I actually had witnessed an investigation of just a basic breach of segregation of duties, and we go back to that fraud triangle of pressure, opportunity, and rationalization. And an AP supervisor had so much pressure. He saw a fraud going on with the controller of this organization, just simply approving and signing checks for his own personal use. But it came down to that there was really no help or hotline available in that organization to give that employee the opportunity to report it. And of course, the pressure is that he has a family to provide for. And we hear a lot about those examples, and I think it's critically important, what's listed on this screen, that these are all in place so that in the event of any type of breach, that an employee feels comfortable to come forward without retaliation in the organization.
I look at that list, and what occurs to me is an old adage that no matter the system of internal controls, there's weaknesses. And the question really becomes, are they being exploited?
Exactly.
And if they are being exploited, or if somebody spots it being exploited, if we had some of those things that are listed on that slide, it would make it a heck of a lot easier to get to somebody who actually can make the correction. So the question really becomes, are the weaknesses being exploited? And of course, ultimately have to figure out what some of those weaknesses might be to determine if they are in fact being exploited.
So to come back to the audience question that Cindy asked us about, which was, what are tangible examples? The examples we've been talking about that are on the slide are examples of what to do when something goes wrong. And if things are going well, hopefully we don't have too many examples of that within our organization.
Right.
So we also have to have in place ways to make the message a constant drumbeat without things going wrong. One other thing, and there are some tangible techniques. A small thing that we do within our organization at Crowe-Horwath is that we have a four-pillared value system that we call Care, Share, Invest, and Grow. And we have a program where people can give awards to each other when they exhibit behavior that's in line with the positive aspects of those ethics. And it's a fairly big deal around our organization. And in that way, the concepts are in front of people all the time, even though something hasn't necessarily gone wrong. But there's positive reinforcement around living the cultural dimensions that we've set forth.
Well, I'm going to move us on to slide 12 because
Cindy, could I just interrupt for
Sure,
a second
sure.
and go back for 1 second? I want to give some more examples of what you're describing that I think are important. If we're aware of what's going on, especially at the board level, perhaps at certain times we should be more vigilant than other times. So a couple of examples of that, I think. I'll call them yellow flags. Comp plans that have cliff funding in them. You hit this number, you get it all. You don't hit this number, you don't get it. If you've got plans like that and you get close to the number, sane people would say we ought to take a hard look at that. Maybe somebody is incented. They will actually exploit something in order to get across the finish line. New acquisitions, bringing new companies in, where the folks of that acquired company may not have the culture and tone of your existing company. We ought to have our antenna up high on that. Or when we're operating in new cultures, how many times have we seen that? There are cultures where, unfortunately, bad behavior is, it's not reported, it's measured. In those cases, if we're into a culture like that, we ought to have our antenna up high to make sure that we've properly evangelized what we want to do. In the accounting world, there's going to be lots of reasons for new systems coming up, right? We're going to have lease accounting, revenue recognition. So we got these big, new, hairy systems that are going to be developed. Clearly, most of them will have weaknesses in the beginning. That's all part of the process. We need to be very vigilant that, in fact, weaknesses are not being exploited. So I think there's things that we can do, Cindy, to help ourselves.
Well, I think that's a good point about the new systems coming on because of some of the new accounting policies.
Right.
So,
Well, absolutely. And when those new systems go online, we should actually be building the control environment up front, actually designing in the detective and preventive controls sooner, right, rather than after the fact.
right. I think that's a critical point. That sounds like a topic for maybe a future webcast. So let's move on to slide 12, because I do want to talk a little bit about the new COSO framework that was unveiled in May of 2013. And what it might mean for companies. So I'm actually going to start with you, Rick, and ask what kind of questions are you getting from companies? I know that this has been somewhat, not controversial, but maybe confusing. When does it go into effect? What are the differences between the old framework and the new framework? And so either from management or audit committees, what kind of questions are you getting?
Well, the first question we usually get is there a shortcut? And the answer is unfortunately no, there's not a shortcut. Generally speaking, the first question we really get is why this change? And without spending the entire time on that, the bottom line is that the business environment's a lot different today than it was in 1992 when the first framework came out. A lot more globalization and a lot more technology. And I think that what we recognized is that elements of the old framework just didn't adapt to that very well. So the way we guide our clients and we say, look, the best way to do this is read it and understand it, and then take a zero-based approach to it. Probably you're going to find that there are not radical differences in what you end up designating as key controls and how you test them and so forth. But what you may find are pockets where you didn't think about controls really being appropriate in that area. The other reason, frankly, that we suggest a bit of a zero-based approach is that it's now been a number of years since Sarbanes-Oxley required internal control reporting, and like anything, it can get a little stale after you've been doing it for a number of years, and this is a good opportunity to kind of take a deeper dive back into that internal control documentation that you have and move forward. From a timing standpoint, Cindy, generally speaking, the sooner the better seems to be the regulatory viewpoint. It does appear that companies can stay on the old framework for calendar 14 without really too much challenge. COSO is going to stop supporting the old framework, actually 3 weeks ago, I think, roughly. So we really need to begin thinking about moving on to the new framework. And I guess one last small thing, it's a nit that only accountants appreciate, but in the reporting that both the company and the auditors do now, they need to identify which of the COSO frameworks are being followed in their public reporting.
Okay. So going on to slide 13, and Ken, this talks about the effective board oversight of risk.
Right.
And you hit some of these points earlier. And so, luckily, though, one of our viewers asked a question that just tees this up very nicely, and that is, what controls can be put in place by the board to ensure open lines of communication and transparency between staff and the board without being filtered by either the CEO or very senior management? So, as we look at the effective board oversight, I suspect that the board members and the audit committee members are going to want to talk to various people in middle management or senior management, but outside the CEO's ears. What advice do you have?
Okay, maybe I'll answer that by coming about it through the side door, because I think it relates well to a couple of the other comments I was going to make. I think there's 4 things that we can focus on here. 1, understand the company strategy. We just issued a blue ribbon commission on this, and we said that the old model of review and consent, that model's probably long past its shelf life. What we're suggesting today is being active partners in the development of the strategy. And that's a great place, Cindy, where boards can come to other persons other than the C-suite and talk about the possibility of executing on the strategy. It's one thing to develop a strategy. It's quite another to actually execute it. And I think that many times we perhaps have not done a good enough job to determine whether or not we have the systems and the people in place to actually execute the strategy. Here's a great opportunity to do that, to get out and talk to people. What do you think about this? What do you think about that? A second area, understand the incentives. If the board truly understands the incentives, now I don't mean just pay. I'm talking about the incentives to get ahead. If let me make it black and white for a second. If you have to be a yes person to get ahead, that's probably not a good thing. You don't want to have those signals all over the place, because then you're not going to get any reporting. So again, that comes back, I think, to tone and culture, to understand the incentives, to understand why people get ahead, get involved in talent management. In fact, compensation committees are changing their name to compensation and talent management. Really, really important. I mean, you want to talk about diversity in companies, et cetera. Here's really where the rubber hits the road. So I think there's a lot that can be done just in the whole area of incentives. 3, there's going to be pressures, right? Nobody wants to not hit the earnings number, right? The whisper number even. People want to hit those numbers. There's lots of other things going on in addition to just hitting numbers. So the pressure is always there. The question in my mind is, how is management dealing with the pressures? If they're just wiping it under the rug, that's probably not awfully good. If they're being tough on the people but not tough on the problem, that's probably exactly the opposite of what you want to do. You need to have a really good understanding of how companies, people are being involved in the pressures. 4th thing I would point out is, and again, this is a great opportunity to talk to the people in the business, understand what the emerging issues are. What are the emerging issues? We talk about asymmetric information risk. What we mean by that is board members have way less information than management people. So the question becomes, how do you determine that asymmetric information risk has become too high? One of the ways you do that is actually talk to staff. Talk to them and hear what they say, stand it up against what you're hearing, and sometimes you're going to walk away and say something just is not right here. So it's a question of understanding what the emerging issues are, understanding what the staff knows that perhaps you do not know, but all under this umbrella. How in the world do we get it all done? And if anybody of our listeners has good ideas on how to get that done, I'm all ears. Okay. But when I think about the task, and I think about the fact that audit committees ought to be spending the bulk of their time discussing, not listening to presentations and monologues, and then we're trying to do all these other things, it is a real difficult task. And I think that's one of the reasons why audit committees in particular, boards in general, ought to be resourced better, maybe a whole lot better. And we really need to start to think about the kinds of folks that actually have the time to sit on these boards, Cindy.
Okay, that's good food for thought. I'm going to move us along to slide 14, just because we have got a number of questions about whistleblower helplines and features of a well-developed whistleblower helpline. We've gotten questions, Carl, and I know that at MetLife, your whistleblower program is available in over 50 countries and extends to not just your employees, but customers and vendors. We also know from the ACFE, the Association of Certified Fraud Examiners, that most frauds are uncovered by tips through the whistleblower helpline. So talk to us, Carl, about what are the key tips that you can give our audience as to what makes a good whistleblower helpline.
Well, certainly. First, I think the paper actually said some very good things about this. That the hotline would be available, one number, multiple languages translated, and that it would go to 2 places within the organization. So these are all very good practices. To have a common phone number that's available on an intranet, that is communicated, that it ties to the corporate ethics policies, to the code, and then when things come in, right? So it has to be available, it has to be communicated, but when things come in, it actually has to be treated very confidentially. Someone's manager should not be aware. If I called, my manager should not know that I called. There should be an opportunity to have that be reviewed in a very confidential way. One of the things that kind of I've learned over time is if you actually put yourself in the position of the individual that's calling, usually it's not me calling, right? It is someone who may be an assistant, may be a staff individual. They have not slept for days, right? Or thought about this for weeks. They've seen their boss do something they don't think is right, and it's been eating them up for a long time. They have to make this phone call, and they do. So it's very important that we actually get back to them, and we treat it in a very thoughtful way. Get the facts and do an appropriate investigation. In our world, our investigatory group is in our compliance department, and every tip is followed up upon. Most tips don't amount to anything. Most tips are really more HR, kind of I don't like my manager or something they did. But there are ones that actually require a great deal of work and result in action. So it's very important that actually then coming out of all that, management's actions are consistent, they're prompt, and that creates kind of awareness that actually all this works within the organization, and that kind of helps with a very positive environment around the hotline. So I guess the moral of my story would be actually to care about the individuals that are making the call, but actually to have the program in place and follow up accordingly.
Yeah, I think that what's interesting about the ACFE report that when it comes out annually is that while tips are the biggest source of fraud, of uncovering the fraud, also employees are most concerned about retaliation or not having the tip being taken seriously.
Right.
So there's that kind of conflict or dichotomy, and so I think following up and making sure employees understand that it's going to be taken seriously is important.
Just to follow on that, how does the panel feel about panelists? Feel about periodic reports as to what's been happening on the hotlines? I know a lot of companies, everything goes in, but nothing ever comes out. You never hear that there were, 41 of these things and 38 of them were really HR, it should have been reported here, or whatever we want to say, but report back. What do you think? Is that good or bad?
What I was going to comment on was kind of close to that. I think one of the nuances of the whistleblower hotline is that its activity is a barometer of the tone in the company. If you're not getting comments, people are afraid to comment. It probably doesn't mean everything's just great. And we know that because of this high number of, say, HR-related comments that Carl mentioned. You know, it's easy to call some of those a nuisance and a waste of resources, but what really happens, you can say, is when we're getting those calls, people feel comfortable making them. And if your hotline's not active, then it leads me to wonder what's in the culture that's stopping people from making those calls. So to your point, Ken, I think that most of my clients that operate hotlines report the statistics at least at the board level. By category, you know, how many are open, what are resolved, what were serious, but and they pay a lot of attention to you know, the nature and timing and placement and source of all these comments to think about the culture, not just about the identifying the bad behavior.
Do they report it beyond the board, though? Do they report it back to the company employees?
They don't publish it to the company in general, but as Carl said, they're very diligent about getting back to the whistleblower themselves about we took your complaint seriously, and in fact most of the good processes include multiple touch points with the whistleblower because these things often take a bit of time to deal with.
Tracy, you wanted to-
Yeah, I was just to say, I think those points are great, and if you think from a circular reference perspective, the fact that you do care and the attention is given, and there's a timely report that shows the turnaround of the response to that whistleblower, enforces that culture of open communication. So it's really that, and to your point, very well said, if you're not getting a lot of those calls, you don't think everything that is perfect. So that is a mechanism to perhaps change the culture to a more positive one in communication.
I hate to do this because we've got a number of questions from the audience about the whistleblower program, but we've got a lot more content to cover here. I will just note for the audience that last July, the Anti-Fraud Collaboration did a webcast specifically on whistleblower programs, and so I would invite our viewers to go to the CAQ's website or the Anti-Fraud Collaboration website, and you can pull up that whistleblower webcast that specifically deals with a number of these issues. So I apologize to our studio audience, but I do want us to move on now to slide 15, because we talked about at the outset that there were three important components. One was the tone at the top. The other was communication, and of course we have been talking about communication as well. But if you look at this slide, you'll see that the hub is the audit committee there, and so I'd like to go around the horn, if we will, and talk about what each of the parties brings to and what their responsibilities are with respect to communications and making sure that there's that robust communication between and among all of the parties, because I think that's a critical point of deterring and detecting financial reporting fraud. So Rick, we'll start with you and we'll just go across.
Well, the point of communications obviously is making sure each party knows what the other knows, and to make sure that together we're covering the waterfront. You could probably draw this chart a lot of different ways, but it really means that all the key constituencies need to have anti-fraud activities as top of mind and as the key subject matter for dialogue and interaction among the parties.
So Tracy, how does management keep internal audit, external audit, and the board
and
apprised?
Really, and again, it's just the ongoing theme that we're all discussing, and that is about that positive two-way communication, that top management, mood at the middle, every level of management does understand the key critical importance of communicating to all the constituents of the financial reporting chain. And as you mentioned before, Ken, about the informal discussions, it's important to have those formalized meetings, and they're documented, accordingly, but also those informal meetings, and just to kind of get the tone of how things are going is a very big telltale sign about, is this really happening in a positive and communicative way?
So Carl, how frequent is the communication at MetLife between the internal audit and the audit committee? And do you have a seat at the table?
I think I do have a seat at the table for sure, and really with probably the board overall. We meet formally probably 6 to 9 times a year, and I meet with my audit committee chair informally over the phone at least twice a month, and we constantly email, and we're constantly in contact. We work together to set the agendas, we're talking about financial statement fraud here, really, right, as opposed to operational. And there are operational fraud reports that go to the audit committee and the governance structure. But from a financial reporting perspective, our audit committee chairman kind of first started off by saying, well, they're all laid out in the 10K for us, right? Because there are significant accounting estimates that have to be disclosed. So why don't we look at each of those significant accounting estimates in the audit committee meetings, and give an understanding of everything that's going around them, and actually where our decisions are being made. So if you kind of are in the black and the white and the gray, where are we? Are we black, are we white? And where are we in the gray? And are we being consistent, right, with how we look toward what is in that gray area? I mean, I could highlight some of the areas that we've covered recently, like looking at legal reserves, like looking at thematic areas around AML or cybersecurity, or how we account for our insurance liabilities.
I think that's important to know what specific acute things you're looking at. So Ken, I'm going to turn to you and ask you a specific question. I want to get your general sense, but we keep hearing how important it is that there be open communication with the audit committee, with the board of directors. But how do you give people the comfort and the assurance, and what are the mechanisms that board members can use to let internal audit, let management know, we've got an open door, we want to hear from you?
Well, a little of this is going to be tough love, so forgive me, membership of the NACD, when I respond to this. But there can't really be communications. I mean, think about your home life. You really can't have communications unless you have trust and support. If the person doesn't trust you, you're not really going to have a communication. You're going to have a monologue. And you might think it's a communication, but in reality, it's a monologue. So the first question is, how does one build up trust? Well, one builds up trust, especially when the price of poker is high. And in these matters, the price of poker is high, right? You build it up over a long period of time. You don't do things which, frankly, destroy trust. Let me give you an example of that. The chief audit executive comes in and says something about, I don't think I have adequate assets to take a look at cybersecurity. That would never happen, I recognize that. But let's suppose that did happen. If you want to destroy trust, if I'm the chair of the audit committee, first thing I do is I go to the CEO's office and I say, well, that guy's whining again about his resources. Well, what's the chances you're ever going to come to me and tell me you've got that issue? So trust in everything you do, in every kind of communication and candor. Second thing, you need to set an expectation. If you haven't set the expectation of what a good communication is, it's really going to be hard to have one. Now, I'm sure we've all sat in meetings, I certainly have, when I would walk in and I would say to a board, what's your expectation? You get deer in the headlight. You need to help the board figure out, and the management figure out, what is the expectation. Because the better it's understood, the higher the likelihood you're going to achieve it. Otherwise, you might achieve it and not even know you're achieving it. And third, and this may sound kind of silly, but I don't think it is, you have to speak in a common language. You need to understand that sometimes board members are going to say something that the management team really does not understand what that means, and vice versa. So I think you need to have trust and support. You need to have expectation in order to have sufficient candor, and you need a vocabulary to support it, Cindy.
I like that. I like that common language, because that's what communication is about. Before we move on to talk about skepticism, which is very important, I want to ask both Carl and Rick your perspectives on any challenges that you've seen between internal audit and external audit, the relationship between the two, and how you foster any tips, leading practices for fostering that robust discussion between internal and external audit. Because it seems to me that together it's much stronger than each individual piece. So.
Yes, right. I certainly agree that together, one and one makes more than two. We coordinate very closely with our external auditors. We plan together. We determine where we are going to look at similar things. And then, we try to leverage each other's skills and talents where possible. Where we can. So I think there's no reason to have an adversarial relationship. It's actually a relationship that can be very well fostered and managed, and that's what we try to do, because I think we both have slightly different views of what we're trying to accomplish. Internal audit, yes, does look at financial risk, but we look at a much broader range of risk, and we certainly don't have the skills and talent that the external audit teams have in terms of up-to-date financial accounting and reporting capabilities. So together we can really cover risk really well and bring a common message actually back to senior management and the board.
Okay, great. And Rick, your perspectives?
Carl said it well. We have somewhat different missions, but we have so much overlap, and I've been sitting here trying to think of the last time I heard of an adversarial relationship within one of our clients and the internal audit group and our engagement teams, and it seems to be very collaborative. I think the professions, organizationally, the professionals are very much aligned and work very well together.
And Cindy, if I can just mention, just even from the management side of financial reporting and my background in finance transformation initiatives to keep the integrity of financial reporting and best practices and internal controls, I understand my role of my internal audit function. However, we have also partnered with IA with regard to project management and making sure that as we are changing and shifting systems, I know as Ken mentioned earlier about the upcoming regulations and accounting changes, very critically important that those are aligned as well. So I've actually had, there is that line, obviously, between management and internal audit, but a very cohesive relationship in supporting those initiatives for the organization. And then, ending up in the integrity and financial reporting.
Yeah, I mean, absolutely. I think, and probably should have added, actually, that the controller, chief accounting officer is every bit is involved in those areas as external audit and internal audit. And what's interesting when you actually start working together and looking at things, a big component of efficiency and being able to get things is actually getting the right information out of the systems early on, right, as opposed to going back after it later. So it's actually people working together, coordinating on what's actually needed, in terms of providing
and also
information.
the less touch points within the process, which I know you folks at Internal Audit truly appreciate.
Yes.
Okay, let's move on to slide 16 and address our third topic, which is skepticism. So we have up here on the slide actually some of the cognitive shortcuts that can lead to poor decisions and judgment tendencies, if you will. And the report goes into quite a bit of detail on this. So, and of course, it's our view that while the auditors, the external auditors, have a professional responsibility to exercise skepticism, all participants in the supply chain have a responsibility, we posit, to exercise skepticism. So let's start with you, Rick, on the professional responsibility that auditors have. The PCAOB standards define it as an attitude that includes a questioning mindset and a critical assessment of the audit evidence. So talk to us a little bit about, and give us some examples on how audit methodology reinforces the need to exercise skepticism when assessing the audit evidence.
I think we've gotten a lot better at this recently because we've begun to really think about the psychology around doing audit work. I'll give an example that we use in talking with our people about about skepticism. In the course of conducting an audit, we collect literally thousands of pieces of information, thousands of which always show that the client's records are correct. It's very unusual for audit evidence to be contradictory. Almost all of it's affirmative. And over time, that creates an enormous bias in the mind of the auditor that the expectation is that the next piece of evidence is going to be good too. And even worse, often when we get negative evidence, let's say a confirmation from a customer, it turns out that when we finally investigate it, it really ended up being okay too. That they didn't understand the question. So one of the things that we have to tell our people, and we stress a lot, is when you find negative evidence, you have to, instead of trying to figure out why it must be wrong because everything else that's negative is wrong, you have to pick it up and say, okay, I need to search for more negative evidence because this is rare and it could be extraordinarily serious because of its rarity. And so just understanding your own psychology, I think, is really, really important here. The other thing that we've begun to do in terms of trying to help our people understand objectivity and skepticism is to have them think about putting themselves in the place of the people preparing the financial information at the companies that we're auditing. You can have the most objective, thoughtful people at the company, but when they are dealing with accounting estimates, which are not the result of hard yes and no answers, they can't help but be influenced about what their budgets are, what their goals are, and the fact that top management keeps saying we're better than the competition. Well, if we're better than the competition, our reserves probably need to be a little bit lower. All of that goes through their minds, even as they're consciously being objective. Well, if you combine that bit of unconscious bias with our people perhaps getting a bias toward accepting the positive audit evidence and maybe dismissing the negative too quickly, you could quickly get something wrong in a published financial statement. So it's this psychology that I think we're doing a lot better at. And to a shameless plug, Cindy, for the CAQ Judgment Framework document, does a very nice job of outlining these issues for people.
Great. Well, thank you for that.
Yes.
And then our staff thanks you, and the working group thanks you as well. So, Ken, I'm going to turn to you because you talked earlier about the importance of trust.
Right.
So it occurs to me that a board member is not going to go onto the board of a company in which he or she doesn't trust the senior management. It would occur to me that if you're going to go into a board, you're going to do some due diligence and see what senior management's like, and decide,
Unless you're crazy.
these are people I can trust.
Right.
So how do you set up yourself to do a good job where you want to trust the people and like the people of which you're going to be helping in your board responsibility, but also have that skepticism? And
Right.
it seems like a delicate balance to me.
Oh, it is a delicate balance because you can actually get yourself pointed in or painted into the corner where you're looked upon as a raving maniac and no one's going to pay any attention to you. A couple of things. I touched on this earlier about asymmetric information. It is there. It's inherent in the process. One of the things that we advise boards to do, and especially audit committees, is one, recognize that asymmetric information risk is there. But the question becomes, when does it become too high, that risk? Well, how do you figure that out? You have to do that through observation and inquiry. Are your numbers different than everyone else's numbers? Are you experiencing no problems and everyone else is experiencing problems? I mean, think about WorldCom. Somehow they were the only company in that segment making profits. Somebody maybe raised their hand and said, how are we doing it since nobody else is doing it? Well, we're capitalizing everything. That's how we're doing it. But recognize that that risk is out there and have some tripwires so that when that happens. Second, I think you have to set the stage for an even flow of information. That's why we say have executive sessions even when you don't know if there's going to be anything discussed. Why? Because if you're not having an executive session, the very first time you do have an executive session, everybody in the hallway is going to be saying, oh my God, what's going on. So you need to have lots of consistency. I think you hit on that. Consistency is really important. You can exercise it through, for example, executive sessions. Third thing, you need to watch questioning. If your questions seem to be prejudicial, that you seem to have your own agenda, that you seem to be making some political points, people are going to have their antenna up a mile high. So you need to be very careful the way you form your questions so that you do not have some agenda or somebody perceives you have an agenda, because you're going to get crazy answers to that. And before I mentioned trust, and it comes in here again, if a question is asked and answered in a way that points out a problem, the worst thing that you can do, Cindy, to break down trust is then go and tell everybody, well, you know, Rick said something that really is a problem and it's going to give everybody a problem. You can be sure that Rick's not going to be talking to you after that particular thing. So, again, it's a trust thing. I don't know, I want to put this under common knowledge or whatever, but remember, when you have a meeting, you can only do three things. Only three things can happen in a meeting, right? You can educate, you can persuade, or you can have a call to action. You can only do three things. If you're trying to use your physical time together as an audit committee or a board to do all three things, it's possible, and it's possibly going to be hit by a meteor too. It's probably not going to work out very well. So what we suggest strongly is that all the education take place before the meeting happens. That when the meeting happens, that you have focused in on some actionable items. And so that the call for action it's well known what it is you're doing, and everyone has some common sense as to what the problems are. And then I guess the last thing is, you just need to be very careful and recognizing, you hit on it on the hotline thing. People need to have, again, a level of trust that will permit them to say, I don't know. And boy, I got to tell you, it's really rare when I sit in a board meeting and somebody has enough courage to say, I don't know. Somehow C-level officers know everything. Well, we know that's not so. You need to have enough trust, the culture has to be right, that you can say, I don't know, I'll find out and I'll get back to you. That's a completely different story than fabricating an answer, even when you don't realize you're fabricating the answer.
Yeah, I think it's human nature. It's uncomfortable to say, I don't know.
It's very uncomfortable.
It shouldn't be, but
yeah.
it really is.
I use it at home all the time when my wife says, I don't know.
I always get yes to. But that's a totally different webcast, isn't it? So, Carl, I'm going to turn to you because this actually segues into a question that we got from one of our audience members. And we've often heard the IIA's President Richard Chambers note that skepticism can have a much broader definition for internal auditors because your mission includes addressing a broad variety of risks, not just fraud risk, but operational risk, reputational risk, strategic risk, business risk. And one of the questions is can operational fraud or operational risk be a segue or a gatekeeper to fraud? But so talk about the judgment tendencies that can apply in all of those areas, and are they different for each area, or are these tendencies kind of the same regardless of what kind of risk you're trying to address?
Yeah, so that's interesting. I don't think that there's a different model for operational risk than there is financial risk. I mean, fraud is fraud. The triangle's the triangle. There's opportunity. There's rationalization. I personally believe that operational fraud is much more common than financial statement fraud is. I think a question that we often talk about is whether operational risk can amount to the point of financial statement fraud. But we tend not to go there because if operational fraud is happening, it's being recorded in the books and records in the proper period. So if a fraud did get so large, that it was significant or material, then okay, it's not financial statement fraud risk, but it is the same thing in terms of how it happens. And I think from a skepticism standpoint, for an auditor or anybody else, I mean, from my experience, sometimes we don't listen, right? So we need to listen. We need to stick to the facts, right? We need to understand what the facts are, and not just based on what someone said. And we have to ask the right questions. And I think the one thing that I've always kind of fell back on is, if I don't understand something, I mean, I don't think that we are all, generally not smart people. We're generally smart people to be in the positions that we're in, and we're educated. And if it doesn't make sense, then we should probably ask again and not just move on, because I don't want to be embarrassed that I'm the only one in the room that doesn't know the answer. And that's usually when we find things that are wrong, because we didn't move on, because we actually went back to a T account because the accounting entry didn't make sense. So I think those are some of the things that skepticism is just, it's very basic. It's not hard. It's just ask the right questions, listen to what people are saying, and stick to the facts. And I think that helps all around.
And sometimes the right question is just the next question, right? You've got to give the person to whom you're asking the question the permission to come forward, because as we mentioned earlier, people are sitting on this having it niggle away at them, and should I say something, should I not say something? So being asked a question that gives them the permission to speak freely, I think is really important with respect to skepticism.
Absolutely.
So Tracy, obviously skepticism is also important for financial executives as well. Are there specific areas when the finance team should be skeptical?
Well, finance teams need to always be skeptical, professionally skeptical. And just to piggyback off of your comment with regard going back to the T account, one of the things that has always been importance to me is understanding information technology and data flows that supports the financial reporting. But I think, Ken, you mentioned it earlier as far as the compensation plans or the way people are compensated, code of conduct, and to see if certain recordings of the books and records or behaviors are driving that could eventually lead to financial reporting fraud. I just really think overall it is management's responsibility in a financial reporting capacity to make sure they do understand every single inflow of data, and if that's a manual point or automation, and without getting into Sarbanes-Oxley and all of that, but that's really how I've been trained for many years, as far as truly understanding balance sheet due diligence and just the way data is flowing in. And then, of course, having those right questions among the staff to make sure that they completely understand the depth and the impact of what they're doing and the impact to the financial statements. So absolutely something on a daily basis that needs to be considered.
So we've got a question from one of our viewers that actually is a good question, because we've talked a lot about red flags, but how do you deal with yellow flags when there's often a cost-benefit analysis that any one of our supply chain participants have to do, whether it's cost-benefit in terms of actual dollars, but probably more about time. So, asking these questions, being skeptical, and yet there's not something really, really wrong that you can point to, but there's a yellow flag. Help us deal with that. How do you address that, given time constraints that people have? I heard somebody once say that the biggest detriment to quality within a company, whether it's audit quality or performance quality, is time. There's not enough time. So how do you balance that?
One of the things we often talk about is where there's smoke, there's fire, right? The first time a yellow flag comes up, you may look at it very quickly and it doesn't amount to much. But then something similar arises, and then something similar arises. So it's you're aggregating, right? The yellow flags to come to a conclusion. So you often see something like that happen in practice.
Yeah, there was a time where the external auditors certainly, while I wouldn't say ignored fraud, looked at fraud very much as any other misstatement of the financial statements.
Right.
Was it material or not material? And intrinsically, the fact that it was fraud was no different than if it was a mistake. And I think those days are well past. Okay, and in that day, you might have asked, do I pursue the yellow flag? Well, today, the auditing standards are being rewritten with a higher emphasis on fraud that calls fraud out specifically. Materiality is no longer the only threshold that you have when you think about fraud. And so I think the issue is that you have to pursue the yellow flags. There's always a limit to resources being applied if you don't find something else. But the threshold for which you do more, and certainly in the external auditor's case, what we would call have an audit response, it's much more of a hair trigger than it used to be, and you just have to pursue it much more quickly.
I want to come back to something you said earlier, Rick, which I think might be lost if not teased out. In my early career, the very first fraud that was perpetrated on me was a case where I was working with a bank, and to your very point, every single piece of audit evidence in this one category was perfect. There was not a single exception to anything. It was incredible. And we kind of gave each other the high fives. I don't know if we were high-fiving in those days. Maybe we were one-wanting or something. But we all walked away and said it was wonderful. Well, the reason it was wonderful, of course, is the whole thing was a fraud. They actually had a back room producing this stuff flawlessly. If they had spent that on the front room, they probably would have made a hell of a lot more money. But the fact of the matter is, these yellow flags aren't always that easy to spot. Sometimes the yellow flag's just the opposite of what you think. And I think it comes all back to you need to be aware of what the various incentives are. Why would somebody be doing this? And if it becomes obvious, that's easy. But lots of times it's not going to be obvious. And that's why you need a team. You need to be able to go back to somebody and say, hey, I just found one of these things. Have you ever seen anything like this? And then maybe they can tease it out. One of the problems with fish in water, fish can't see water because they're in it. Well, when you're talking to people who are in this every day, sometimes they just can't see these yellow flags. So, yeah, you're right. You can't trace them all down. You'll get old trying to do it. But if you really make yourself aware of what the incentives are and what weaknesses could be exploited for what purpose, you'll be in much better shape.
Okay, great. So I'm going to move us on to slide 17 because I think it's important that we talk about the global issues. That's one of the new components of the Fraud Resistant Organization report, is that it has these global notes in there, and actually a chapter on building a global fraud resistant culture. But as we move on, I will remind everybody, since you raised it, Rick, about the judgment framework, the CAQ's judgment framework, because there is a whole discussion in there about how to avoid common judgment tendencies and the psychological aspects of judgment. So, but talking about the fraud-resistant organization from a global perspective, we've got on the slide here the most common compliance risk factors of concern in emerging markets such as Brazil and Russia, India, and China. And over 2/3 indicated that the acceptance of corrupt business practices of the greatest concern to the respondents. And so, Carl, I'm going to start with you because I know, as we mentioned earlier, MetLife operates in 50 countries. And so how do you, in such a broad footprint, address the issue of corrupt business practices over so many different cultures?
Yeah, it is
daunting, I would imagine.
What? No,
Daunting.
It's consistency, right? It's actually having global standards and global policies that act as a minimum standard locally. And as you enter into countries that have specific rules and regulations, that your global standard is adjusted to add in those local. So it's a very consistent program. But to do that also, you do need to have pretty solid awareness of what it's like to operate in each of these countries. You may not get your mail delivered in certain countries if you did not facilitate that from happening. That sounds really bad because it's a facilitation payment, but actually, if it's norm in that country and it's documented and it's tracked, then that's norm. And I think understanding what is norm and what is not norm, and what is bribery versus mail delivery, is very important to understand in operating in multiple different countries, and always adhering to that global standard, never giving in, and adjusting that locally so that it can be managed accordingly.
So Ken, from a audit committee or a board perspective, how can boards help companies mitigate the risks in these other cultures?
Well, we're beginning to see, and it may have come from the Chinese coal company incident, but we're seeing companies proactively, in order to try to evangelize the right culture, pick a U.S. national up and put them in that country, for example, so that there's some leader there who isn't in the same water. That leader can say, here's right and here's wrong. Here's the way we look at it. Because sometimes when you're in a different culture, it's very difficult because there's really no real common language. People really actually don't believe what we tell them, and it must be some sort of miscommunication. So that's one thing we can do. Second thing we can do, from a board perspective, we can ask management, what specifically are you doing? We have concerns there. There are companies that will help you figure out which cultures are of the greatest risk because of what things. So they help you focus in on it. So you could ask the management team, what are you doing? How's it working out? What kind of results have we seen thus far? What kinds of issues do you think are at higher risk than other issues? So there's those things we can do. There are those audit committee members. Now, there's two sides to this. I'll tell you that right now. One side says audit committees ought to go to these different countries and visit everybody. There's another side that says, look, no audit committee member ever saw a dirty factory floor. Everybody knows a person's going to show up. They're going to make the place spick and span. What are you actually seeing? I don't really know the answer to that question because it's true. They know you're coming. To go there and not have them know that creates another whole kettle of fish.
Going back to that trust issue.
It
right?
really does go back to that trust issue. So it has to be the right balance. My personal view is you got to really lay this at the feet of management. Management's got to hear that you think it's an issue. You need to understand what they're doing, and then for Pete's sakes, make sure they got enough resources to do it. Because if they don't have enough resources to do it, it isn't actually going to get done. And obviously, this is a case, Rick, where with the external audit, you can ask external audit when they're looking at the risk characteristics for the upcoming audit, what are you doing in JBIP? Because we've never operated there before. And hopefully, external and internal audit can help us think our way through that.
Yeah, this is an area that really differs on the scale of the company.
Right.
And I think Carl and Ken's comments really sort of presuppose a pretty substantial organization that has the ability to drive resources in. The reality is that most U.S. companies doing business abroad are smaller, and if you're a $400 million manufacturer today, you're doing business abroad. Either manufacturing or sales offices or what have you. But you may only be doing it in one or two or three locations. And the challenges are much more basic in that environment. The challenges are, do I even understand the laws of the country? Are there property rights? Is there an effective court system? And these are very important to their, over the last half dozen years, there's been a lot of discussion about the credibility of financial reporting in China. and in some areas it's been accepted as very, very good, and in some areas it's been flat out fraudulent. And for a smaller company, this is a huge issue. And for internal auditors, external auditors, it's a huge issue. There are countries where if you were to use one of the most basic auditing techniques in the U.S., send a confirmation to a bank, the bank will receive the confirmation, call up the company, and ask what numbers they want filled in. and that's
You don't have any errors that way.
It's just that you have to understand the basics, and there are many assumptions that we have because we're U.S. centric or say even Western democracy centric, where you're used to the rule of law, you're used to credit being good largely, you're used to people's word generally being good, and so forth. And if you don't understand the differences between China and Russia and Western Europe, you're going to get in a lot of trouble. So I think that, to me, the issue becomes more of a question of beginning at a much lower level of basics for the vast majority of companies, which are smaller scale, and making sure you really understand and prepare yourself for what's happening when you're working in those countries.
So I know that there are countries and cultures where it's frowned upon, if not verboten, to question your superior. And Tracy, I know FEI recently opened up a Tokyo or a Japan chapter, and there was actually an event in Tokyo where this was addressed. Share with us some of the learnings from that, how you deal specifically, because it's not just in Japan, I think, where there's that kind of, you don't question the person above you.
So much for that professional skepticism.
Right.
And so with that said, it is, as you mentioned, it's not embraced in that country culturally. It's looked upon very negatively, almost as a challenging of honor if you are going to question your superiors. Actually, one of the great case studies that you reference in the fraud-resistant organization is the Olympus whistleblower case. I had the opportunity to hear him speak, and anybody who hasn't had a chance and doesn't know all those details, but that is a perfect example of someone who came into a culture, questioned the board for perhaps some erroneous payments that were being had, and was dismissed accordingly. So that is probably the best example of a CEO who was completely disempowered by just asking the question to get it correct.
Mm-hmm. So that brings us back to courage, I think, yes.
It does.
So Carl, one last question for you before we move on, and because we mentioned that your whistleblower program is in 50 countries, how do you set up a whistleblower program in countries because of the local laws? I mean, are there impediments there? I know you mentioned consistency, but are there other issues that companies can use will confront, and then tips to overcome those tendencies?
Yeah, I think there's other forms of communication that can also be acceptable as well, in terms of emailing or calls to members of management in country, or to myself, or to the head of compliance. So there's a number of avenues that are available that can be considered when there are cultural differences.
Okay, let's turn quickly to slide 18, because we've got some other tips up here with respect to building a fraud-resistant culture in a global context. And we talked about tone at the top. We talked about the importance of instilling an ethical culture and a code of conduct. And so any last tips with respect to challenges that companies will face when trying to incorporate these types of programs within a global organization?
I just think it's about making sure that the whole constituency globally understands the Foreign Corrupt Practices Acts and all those type of regulatory items, so they understand the consequences of actions. Any other thoughts?
I think another challenge is employee evaluations. Employee evaluate, nobody likes them, especially if there's anything negative. And in certain cultures, what we think is totally acceptable here is totally unacceptable there, the one that you mentioned, Cindy. That might be upwardly oriented, but still in all, sitting down, having a candid discussion with somebody in a different culture, if they're not prepared to hear it, and if you haven't tailored it to the scenario, you could end up with some pretty drastic results. And I happen to think that employee evaluations are one of the most underutilized tools that we have, and one of the reasons, by the way, that most employee evaluations are pretty awful. That's one of the reasons I think we're turning to talent management, recognizing how important they are for that management, but I think we're a long way from where we want to be.
Okay, well, we're almost out of time, so I'm going to turn us over to slide 19, and this is something I always like to do, which is ask each of the panelists. We've covered a lot of ground today, and so I want to go around the horn again, and ask each one of you to, if you could leave our viewers with just one key point, what would that be? What was your one last thought that you'd like them to know? So, Rick, I'm going to start with you.
Okay. Well, I really think that in general, fraud risk and anti-fraud efforts just need more conscious agenda time. I think that in the limited amount of time that's available in all of the constituencies that we've talked about today, management, internal audit, the boards and audit committees and the external auditor, when those groups get together, we seem to have a fairly limited amount of time, and I find that fraud and anti-fraud issues, unless we are being responsive to an incident, gets almost no agenda time. And I think it's important that we raise the prominence of this issue in the agendas when we're all together, and I think we need to be more diligent about allocating some time in those discussions to the topic in advance of something that we have to be reactive to.
Ken, your top takeaway?
My top takeaway is let's not have a scenario where we have a big bowl of pablum, and somewhere in there is a raisin, and it's up to the board and everybody else to find that raisin in 1 hour. I think that giving people reports, as to my earlier point, that fill up 700-800 pages is not helpful. I think that really what we need to do, especially in the compliance-oriented agenda we find ourselves now, we need to make board reports way more actionable. I think we need to make senior management reports way more actionable. Stop looking at all the right data and start looking at what the anomalies are. What are the yellow flags? What are the potentials? That way we can focus people's time.
Great. Carl?
Transparency and communication, and I'd like to play off Ken. I'd be concise in my communication to the board as well.
Right. And Tracy, I'm going to give you the final takeaway.
Well, thank you. Well, I would say that management definitely needs to take the lead in detecting and deterring fraud. They need to be very proactive in utilizing partners in the financial reporting supply chain. And it's very important that the management team keeps that open communication. Remember, positive tone at the top. Keep up to date on regulatory issues, economic issues, things that could impact the financial reporting environment, and take internal reports seriously. And don't rest on your laurels. Make sure if you see something, say something.
Great. Well, that brings us to the end of our webcast. First of all, I want to thank each one of you for a fantastic webcast. So Ken from the NACD, Carl from MetLife, Tracy from FEI, and Rick from Crow Horwath. I think it's been a really fantastic webcast and a lot of good material here. If your colleagues were unable to join us, they can access the webcast on the CAQ's website. It's www.thecaq.org. And also just a quick reminder for those of you who want to get your CPE credit, it's ready immediately following the webcast, and all you have to do is click on the CPE button at the bottom of your screen. If you don't have an opportunity to do that now, immediately after the webcast, you can do so within 24 hours, after 24 hours I should say, by logging back into the event and clicking the Get CPE icon. But note that if you were not able to respond to the audience attendance checks you won't be able to access the audience attendance checks in the archive, so you won't get your CPE credit. If you have any questions regarding NACD credit, you need to contact the NAC directly. So again, I want to thank you all for joining us. I think it's been fantastic, and I'm Cindy Fernelli, wishing you a pleasant day.